Discussing current mortgage rates, one often hears about the U.S. Federal Reserve's key interest rate. However, in reality, the two are not tied to each other. Rather, both of these rates are tied to the same economic forces. So if the Fed doesn't directly influence mortgage rates, then what does? Well, there are two categories of factors to consider: market and individual. Individual factors are within a mortgage seeker's control. These are things like a person's credit score, the type of property that they're buying, the type of loan they're looking for, their debt to income ratio, and the size of their down payment. Conversely, market factors are those outside of a person's control. Overall inflation is one such factor, as rates tend to rise and decline in tandem. Job growth is another one. Lower or negative growth equals lower mortgage rates. And perhaps the most direct influence: bond markets. You see, lenders need to make a profit, one that is ideally better than alternative investments. So most mortgage rates are set based on comparing the return of other investment options, plus factoring in risks and servicing costs. One of the primary comparables is bonds, which are very similar to mortgages, as they are essentially long-term loans. And if you had to pick just one to watch, the 10-year Treasury note, or T-note, is perhaps the most influential comparable we have in the US. One last factor to consider is our capitalist economy. Rates vary from lender to lender because they compete with each other and have different levels of risk tolerance, fee structures, and processing capacities. So shopping around or using a mortgage broker can definitely lead to a lower rate. Good luck out there.